Know how to trade from start to finish, how pros read the markets, how to place orders, how to know when and why to trade, how to get in and out of your crypto trades for profit, and just a practical step-by-step guide of how to increase your chances of making money with crypto trading. This is it. Hey guys, James here. This is a unit by unit course to get you from beginner to confident trader. All of the resources, links, extra information, extra videos, and the timestamps for each unit are listed in the description for you. Definitely look in there to learn more. And I really hope you get a lot of value out of this video. So I'm going to get started with just telling you what the course is going to give you. At the end of this video, this is what you're going to know. We're going to start with cryptocurrency basics for beginners. Now, if you already know this and you want to skip through the beginning parts, then that is up to you. Go and check the description for all the timestamps. But we're going to go through actually what cryptocurrencies are, why you would want to trade them, then what is a stable coin. That's really important. We're going to go through the best crypto news and education sites so that you can actually go and do your own research. Also, what are the best crypto trading venues for each and every user, because we are all different. Then I'm going to go through and compare centralized versus decentralized exchanges, why use one over the other, what are the pros and cons. We're going to go through some crypto trading strategies. So if you want to know actually how to go ahead and implement some strategies to try and get some money when trading crypto, then we're going to go over that. That will be for beginners, but that will link with a unit later on in the course, which is going to go over specifically how to actually put orders in, where to put orders in, and why we would do that. If you are new, then I'm going to go over all the crypto order types as well. So what is the order book? What are market and limit orders? Why do we use these when we're trading? Then we're going to go over technical analysis for crypto. That is a really big unit. It is chock full of information, really great information. So I definitely recommend looking at that one. After technical analysis, we're going to go through and trade. So you're going to see me go through some sample trades, why I chose that trade, where I put my stop loss, where I put my take profit, and then just a recap of the course in general. Before we get into the course and all of the units though, just a quick self-introduction. If you don't know who I am and you haven't watched the channel, used to work on the London Stock Exchange for over 5 years, got a few certificates. And this is not financial advice. I'm not your financial advisor. This video is not financial advice. Please just take it for education and information. All trading involves risk and a significant risk of loss. So just keep that in mind. Okay, let's get into it. The first unit is crypto basics. What are cryptocurrencies? What are blockchains? What are the different types of blockchain? What are the different types of crypto? And how can we use tokenomics to actually go and research cryptocurrencies? What are cryptos? They're just tokenized assets that represent value, not really much more than that. Not all cryptos are created equal though. There are better coins, better blockchains, more useful blockchains, and there are poor blockchains and low quality blockchains as well. In terms of barriers to entry, especially for us retail investors, there are very low barriers. You can sign up with an exchange, get trading straight away with very low fees. So that's definitely a positive for trading crypto over something like Forex or even stocks, 24/7 trading as well. There are different types of blockchain and cryptos that we can trade. You have blockchains that really focus on being a currency, which is just a ledger of transactions. That's all it is. So the main example there is Bitcoin. Litecoin is a fork of Bitcoin, and actually Dogecoin, I think, is a fork of Litecoin. So it's a fork of a fork. But essentially these blockchains do one thing only, and that is keep a ledger of people transacting. Now, stable coins are a little bit different. They are definitely used as a currency, but they're not usually their own blockchain. They're usually built on a different type of blockchain known as a smart contracts blockchain. So the main one there is Ethereum. This blockchain is different to Bitcoin. Whereas Bitcoin is simply a ledger of transactions, Ethereum allows people to actually enter into contracts on the blockchain, which means you can have a lot more uses on that blockchain. You can actually issue different types of tokens on Ethereum. So you might want to go and trade, let's say Uniswap, which is a token. That's actually an Ethereum-based token. These are known as ERC20 tokens. So it's good to know the differences, because when you're investing in cryptocurrencies, you've really got to know what you're investing in. Are you investing in a main blockchain? Are you investing in a different type of token? So these are the main smart contracts blockchains right now. They are very different to the currency type blockchains. Now, these are the types of cryptocurrency. What do you want to trade? What do you want to invest in? Where do you want to focus your resources? Do you want to trade currency tokens? Really here, this is like trading gold or something like that, where there's not much value apart from the value that people actually think it's worth. But then you have different types of tokens like exchange tokens. So a lot of exchanges like Binance and KuCoin will have their own tokens, so you can trade those. Different type of value proposition. You also have protocol tokens. Injective protocol is a good one. So that code actually does something specific and they have their own token. It's going to be a very different investment proposition than something like a currency token. DeFi tokens are really popular. Utility tokens could have many different uses on a blockchain and can be very important over time. You even have stock tokens, which is a way of trading the value of a stock, but with a cryptocurrency. Definitely some positives of doing that overall. And then you have NFTs, which are totally different. So all of the cryptocurrencies that you'll trade will be known as fungible tokens, the same as fiat currency. If I gave you $1 and someone else gave you $1, those dollars are the same. You can swap them around and give them back to someone else, and they are all the same, or otherwise known as fungible. Non-fungible tokens are completely different. They are like art. There's only one Picasso painting of each certain type. There is only one unique piece of art that a person makes, and so that is non-fungible. It cannot be swapped around, and that is what NFTs do as well. NFTs are a completely different value proposition and investment as well. It's like investing in art. NFTs can be used for a lot of different things though. And then we come to shitcoins and scams. Obviously, there are a lot of these and you want to steer clear of those. All right, so what is tokenomics? Tokenomics obviously is a mix of tokens and economics. We can look at the value of a cryptocurrency, the supply of it, which is super important. If it has an unlimited supply, is that going to affect the investment over the long term? If it has a very limited supply, then if a lot of people want to buy it, the price might rocket up. The volume in terms of the trade, daily, weekly, monthly, how much is the project worth? So each cryptocurrency is a piece of a wider investment. So Bitcoin has a certain amount of coins and you add all those up and then that gives you the market cap. Also, who holds that crypto? That's also super important because cryptos are really here for investors to invest, but also for projects and companies to raise money. Who's invested in it? That's obviously important to know. Burning tokens is also super important. If a company burns tokens, it literally takes them out of circulation. And if you have the same demand and fewer coins, then the price should appreciate. And then we come to one of the main reasons of a cryptocurrency, especially these days, is ICOs and IDOs, or basically initial coin offerings, initial DEX offerings, essentially just a way for the project to issue cryptocurrencies to earn money and investment so they can build their project. Let's go over to CoinGecko.com, which is a very popular site for the cryptocurrency space. And we can do some really easy tokenomics right now. Let's look at Bitcoin. Here's the price, $55,290 right now. So cryptocurrencies are valued in dollars because everyone knows what dollars are and they can easily compare it to other investments. It's the world's reserve currency. Everything is valued in dollars, so it makes sense. So this is the price of one cryptocurrency right here. And then we have the 1 hour, 24 hour, and 7-day change in terms of the percentage price changes. 24-hour volume. This is all of the trading volume in Bitcoin over the last day, made up of all the different exchanges that do trade Bitcoin. It's given as a US dollar value. So $72 billion worth of Bitcoin was traded over the last 24 hours. Then we have the market capitalization, which is a very easy calculation to do. You take the price of each coin and you times it by the amount of coins in existence, and that gives you the total value of those coins. In the case of Bitcoin, this is $1 trillion more or less. Let's click into Bitcoin and we can do some more tokenomics. We can come and have a look at the market cap rank, super important. We can also go and look at the website if you want to know more about the project. Every site will have docs and you can go and read those. Also on the right hand side, you have the tokenomics again, and really important when looking at cryptocurrencies is the circulating supply and the max supply. So right now we can see that Bitcoin is nearing the limit of its supply. Once there are 21 million coins that have been made, that's it. There will be no more. And so we're getting very close to that. It's going to be a good few years from making this video until we reach that supply cap. But one of the main reasons that Bitcoin is where it is because of a limited supply and a high demand, meaning a high price. That is really very basic tokenomics though, so you can really quickly compare projects very quickly. But if you want to go deep, then you have to go to the project's website and have a look at their docs. So you can see all this information can be found in the project docs. That will be on the project's website. As an example, Solana right here, we can see the token supply distribution. This means we can see who is holding it. Seed sale, 16%, founding sale, 13%. So founding sale is very early investors. If this is very high, Are those founding investors going to sell out when the price goes up? Maybe they'll lock in some profits. So when are they actually going to sell? A lot of the time, founders will actually have a time limit. So maybe they'll have to hold on for 2 years. But once that expires, are they going to dump all their coins on the market? That could obviously put pressure on the price. So it's very good to know these things. You also have how much the team has. So the team itself that developed it has 13%, and then the community has 40%. So you can compare these distributions from one project to the next. Let's recap Unit 1 though. Cryptos are tokenized assets. That's all they are. They represent value and they are a digital representation of that. There are many types of blockchain and tokens for different use. NFTs are unique and not fungible. Cryptos are fungible. Each and every token, each and every project is very different. The tokenomics are different, so we have to know them before we start getting invested. Before we get into Unit 2, here are the best crypto news sites and info sites and how to do your own research. I've listed them here. You can go and look at them. I think these are really great and full of information and will definitely give you a lot of very good knowledge about cryptocurrencies. Let's get into the basics of trading cryptos then. And if you're getting value this far, make sure you are subscribed and also like this video. But I'm going to go through what a currency pair is. So when we're trading cryptos, we have to trade in a currency pair. Also, what is a stablecoin? Super important for beginners to really understand what these are. A base versus a quote currency, really important when you're trading. And then trading currency pairs in general. Okay, so what is a currency pair? When you trade cryptocurrencies, when you trade currencies in general, when you trade Forex, you have to trade in a pair. If you want to buy something, you of course have to sell something in return. Now, when you go into a shop, you've got all the prices there already, and the thing you're giving the shopkeeper is a fiat currency, usually, let's say US dollars. When you're buying a currency though, you have to give them a different currency. It's exactly like swapping your money at a money exchange when you're on holiday. So we are exchanging two currencies, and this is how you will see them right here. So we've got BTC/USDT. What does that mean? Well, each crypto has a ticker. So BTC is Bitcoin, and then /USDT. USDT is called US dollar tether. It's a very popular cryptocurrency and a very useful crypto. I'll get into what a stable coin is and US dollar tether in a second. This is how we read a currency pair. You have BTC against US dollar tether. ETH is Ethereum, so Ethereum against US dollar tether. So you know this trading pair is Ethereum and US dollar tether. And then you have other currency pairs like Bitcoin, Ethereum. So if you just want to trade them directly, you can trade Bitcoin and Ethereum. This is how it will look. We need to get into stable coins though, because these are the entry into the crypto space, and they're also used to trade against every other crypto. So a stable coin is a crypto version of a fiat currency. It is always a crypto version of a real asset. So it doesn't have to be a fiat currency. There are other stable coins that are backed by other very stable real assets, maybe like gold, but it is definitely backed by a real world asset. And that's why it's called stable coin. Its price is pegged to that real world asset. So let's take US dollar tether, which is right here. Also US dollar coin, which is this one, and then Binance US dollar. All three of these are pegged to the US dollar, meaning their value is the exact same value of the US dollar. They do this through various different mechanisms, but you know that if you are holding Binance US dollar, USDT or USDC right here, that will be worth $1 US from now going forward. So it's a really important asset for a lot of people. If you want to come out of a cryptocurrency, you think it's too risky, you can come actually into a very solid real world asset without having to take your money out, and you just put that in the stable coin. So now we know that we trade currency pairs, we can look at the base versus the quote currency. So this is really important to know when you are trading. Here is how it will look. The base currency is the main currency that you're buying. So if you want to go ahead and trade Bitcoin, you can see down here that Bitcoin will be on the left-hand side. That's the base currency. The quote currency is the currency that you're selling or using to buy the base currency. So the base currency you are using, in this case, we can see BTC, it's definitely Bitcoin. And the quote currency tells us how much we need to buy 1 unit of the base currency. And I'll show you the quote right here. So we've got Bitcoin, that's BTC. So we know that that is the currency that we're trading. We can look at the quote currency, which is US dollar tether. So that is the quote. We then have 50,000. What does that mean? It tells us that it takes 50,000 USDT, which is the quote currency, to buy 1 BTC, which is the base currency. This will obviously change depending on the exchange rate between the two currencies. Once more, we have BTC against US dollar Tether now at 55,000. So it now takes more US dollar Tether to buy 1 Bitcoin. This can also be shown to you in a percentage move on a day. You'll see this a lot of times. Let's go back to CoinGecko right here, and we can come up, go back to the homepage. You can see this right here. You'll get a percentage change on the day, and this is a percentage change against US dollar Tether. So we'll go back to our quotes and we can see that Bitcoin has appreciated against the US dollar by 5% today. This percentage move will always be how the base currency is valued. So it takes more US dollar Tether now to buy Bitcoin because Bitcoin has appreciated 5% against the quote currency. Also really important to know when you're trading is that not every currency pair is supported. So let's say you have a really small altcoin that's like a micro cap. It's not going to be traded against Bitcoin directly. So I've got an example here of Mana, which is Decentraland. It is an altcoin against Cardano, which is another altcoin. It doesn't have a market, at least on Binance. So if you want to sell one for the other, you just can't do it. You're going to have to first trade Mana into US dollar Tether and then trade ADA against US dollar Tether. So you have to use a third currency to actually trade that. This is sometimes known as a cross trade, where you use a third large currency to trade two smaller currencies that don't have a direct exchange. This is why stablecoins and US dollar Tether in particular are so important. They really do help liquidity in cryptocurrencies. All of the big cryptocurrencies though do have direct trading pairs, and this is how you can trade one currency against another. So I have an example here. Let's say you took $1,000 and you invested $500 each, 500 in Bitcoin and 500 in Ethereum. They're the top two cryptos and they both go up in value. Both have gone up, so we're super happy. But you can see here, Bitcoin actually went up 20%. So our $500 times 1.2 is $600. Ethereum though, only went up 10%. So $500, this for is supposed to be $1. $500 times 1.1 is $550. Now, if you would have just put all of that money in Bitcoin, you would have made $1,200 because you would have gone up 20%. $1,000 in Bitcoin and Ethereum, you only made $150. So actually you would have been better to just put all of your money in Bitcoin and none of it in Ethereum. Bitcoin went up more than Ethereum. And so you can see investing becomes pretty complex, and we're not going to go into diversification here and the benefits that that gives you. They might go up and down at different times and they might have different investors. And so diversification is very key in my opinion, but just to show you how actually trading in one or a different cryptocurrency can definitely change your investment outlook. This is what we call currency pair trading. Which one of these cryptos do you think will outperform the other crypto? You can actually bet on one crypto versus another. This is not just an investment in one coin, but you can think, well, which one of Bitcoin or Ethereum over the next 6 months is going to outperform? Then you want to put all your money in that coin. If you've done research and you think Ethereum is going to outperform Bitcoin over the next 6 months, then what's the point of being in Bitcoin? Put all of your money in Ethereum and it will outperform. You will get a higher rate of return. When you buy cryptos with fiat currencies, so if you've got US dollar or pound sterling and you're just putting money in, then you are actually betting against those currencies, pound sterling and US dollar. If you're selling those to buy cryptos, you're betting against fiat currencies and you're placing your bets into cryptocurrencies. That's what you're doing. Whenever you sell a crypto to buy one other, then you're actually betting against the one you're selling. This is the most basic strategy when it comes to currency investing and with cryptos. The currency you're selling, you're betting against, and the currency you're buying, you are thinking that that one will at least outperform the one that you're selling. So let's just recap on Unit 2 then. Currencies only trade in pairs. You need to sell one to buy another. Stablecoins are absolutely vital for the cryptocurrency industry and for trading. We can analyze the quote and base currency to tell us more about how that currency pair in particular is trading, and you can bet on one currency versus another. Unit 3 is the best crypto trading platforms. Really important that you know the difference between them, the pros and cons of each. If you are getting value out the video, make sure you are subscribed if you aren't already. Also, everything in this video is listed in the description for you. So everything you need will be in there. Definitely check it out. What are the best trading platforms? What are the best trading apps? What do they offer us? And what are the fees of each? Let's start with eToro. I've used eToro before. Now, eToro offers many different things, not just crypto trading. You can trade stocks, you can trade CFDs, you can trade commodities, and they have something that eToro called copy trading, which is where you can essentially invest in someone else and you can copy their trades. That might be something that you want. It is definitely the best all-in-one solution in my opinion. You don't have any trading fees here, but they take some money out of the spread. I'll explain what the spread is later on in the video, but you should be paying maybe 0.25 or 0.3%, something like that. Depending on how big the spread is, you can even be paying as low as 0.1. So I think overall their fees are competitive. You won't be paying any fees on top. They'll take those out when you trade. And you can do staking on eToro. eToro also has eToro X and eToro Wallet. They are specific crypto trading platforms and they are very good in my opinion. You do need KYC though, so you're gonna have to give them your ID documents to go and trade with eToro. Overall though, a very good system. We also have Kraken, which is a dedicated crypto exchange. You have Kraken and Kraken Pro. In my opinion, Kraken Pro is really great for pros. A lot of information there, pretty much everything I would want when trading. You get some good staking products, not support for every crypto when staking, but the ones they do support have very good rates of return. They have very decent coin support overall. If you're in America, you might want to check this one out. The fees are very low, 0.26% or below, depending how much you trade. You do need to give them your ID documents. Coming on to crypto.com, this one is a little bit different. They focus more on their smartphone application, which I think is very good. They want you to use crypto to buy and sell things. So they actually give credit cards as well. If you have a lot of cryptocurrency, you'll get super good rates on credit cards, cash back on purchases. So it actually lets you try and spend your cryptos in the real world, which is definitely something the other exchanges don't do. It is very CRO focused. CRO is crypto.com's cryptocurrency. You need to hold a lot of that on account and you get huge discounts off your fees and you get a lot of bonuses as well. Definitely good for some people, this one. We also have Coinbase, which is a dedicated crypto exchange. They'll be making their product offering bigger as time goes on though. You have Coinbase, which is the easy option on your phone. And then you have Coinbase Pro as well, which is slightly more advanced. However, saying that, this is for beginners only. You have very poor support when it comes to staking. You also have very poor coin support overall. And the fees are astronomical. You'll be paying 2 to 3% on Coinbase, and on Coinbase Pro, 0.5%, which isn't that great. Coinbase for me is for first timers. If you want to buy Bitcoin and Ethereum with a fiat currency, then just use Coinbase. But if you want to do anything more than that, I would suggest other platforms. We also have KuCoin, which is one that I really like as a platform. It's a dedicated crypto exchange. It is an alt exchange. So if you can't find an altcoin on another exchange, you might want to look at KuCoin. The thing with KuCoin, it's not that beginner friendly. It's not great at actually using fiat currencies like US dollar to go ahead and buy a cryptocurrency, and you can't withdraw fiat currencies from the system into your bank. It's just not something they support. This is a crypto exchange, and so it has extremely low fees, but you do need to be an intermediate to advanced user and have other exchanges as well that you can actually transfer the cryptos back to if you want to take some money off the table. There's no KYC on KuCoin. You can set up an account and start trading with cryptos. You don't need KYC. Huge benefit of this exchange. And if you are a US citizen and you're banned from other exchanges, you might want to have a look at KuCoin. Binance, though, is really the king of crypto exchanges. I would recommend every crypto trader to have Binance. They're just simply the biggest and baddest crypto exchange. They have a vast amount of products. You have trading, you have a decentralized exchange, you have derivatives on here as well. Pretty much everything that you could ever want, Binance has. It has amazing staking support as well for coins. It has amazing coin support. It has the lowest fees I've seen at 0.075. It has the highest liquidity as well. That's for Binance. Binance US is a little bit different. The product offering is different and you don't have as many coins. If you're in the US, you're just going to have to deal with that. But Binance is the number one pick for me. I would suggest that you go with Binance, at least having that as an account with some others as well. Here are my thoughts on exchanges so you can go and have a look at them. All of these exchanges are listed in the description. You can go and have a look and see which one is best for you. I think all of these are great for different people. So let's recap Unit 3. Just pick the best platform for you. If you want to actually trade cryptos, don't use Coinbase. It's just not that great for that. Later on in the video, I'm going to get really specific with technical analysis and how to input trades. Coinbase isn't going to help you with that. I would suggest Binance, KuCoin, or Kraken if you want the pro tools. Unit 4 is centralized versus decentralized exchanges, and you may have heard of both of these. What are the pros and cons of both? Should you use a decentralized exchange? What are the benefits of DEXs? What are liquidity pools, and which one should you choose? Let's get into what is a DEX. Well, a DEX is a decentralized exchange, meaning that it's essentially just a bit of code and that's it. When you have a centralized exchange, then that is actually a company that provides exchange services and liquidity. It provides you all the systems for people to go and trade with each other. A decentralized exchange is just a bit of code on a blockchain. It has no central operator and you're on your own 100%. On a decentralized exchange, you don't actually trade with someone else, but you swap tokens. It's a really different type of trading, but you do have very low fees. You can see you can pay around 0.05%. So the fees are very low, and that's because it's literally just a computer program. So I've got two examples here. You can see Uniswap up here, and you can see PancakeSwap here, essentially doing the same thing, but they're on different blockchains. Uniswap is on Ethereum, PancakeSwap is on Binance Smart Chain. Swapping is super different to trading. I'll get onto that in a second, but essentially when you swap, you're just using the blockchain and the decentralized exchange to go into an existing pool of assets and use your currencies to swap for the currencies inside the pool. Very different from a centralized trading exchange where the exchange actually just matches buyer and seller directly and you trade together. What are the biggest DEXs though, and the biggest blockchains for DEXs? Well, you have Ethereum, which is a smart contracts blockchain. You need a smart contracts blockchain for a decentralized exchange and swapping because you need smart contracts in there. So Ethereum has Uniswap, by far the biggest. Binance Smart Chain has PancakeSwap, by far the biggest on Binance Smart Chain. Then you have Solana, Cardano, and Polkadot. They have some DEXs growing on there, a lot smaller than Ethereum-based DEXs though. What are swaps then? You can see right here, this is a swap. You can swap one token for another in a completely decentralized way. The fees are way, way lower, so that's definitely an advantage of a DEX. You have to use a crypto wallet though. This is not a company that is providing you a service. It's simply a computer protocol, and you need a crypto wallet and coins in a wallet to actually go ahead and swap. And the way that you swap is through a liquidity pool. So people put all of their coins in and then you can swap in and out of that pool. This is PancakeSwap right here. So you can see I'm actually exchanging Binance coin into Cake tokens, and I'm using a liquidity pool to do that. Liquidity pool is a massive collection of tokens. So you have other people, and these are called LPs or liquidity providers, and they provide their tokens or just literally give their tokens into the pool to provide liquidity for other people that want to swap. The reason they do that is because they earn fees. Liquidity providers or LPs earn trading fees, and this is great. So you can actually earn fees yourself. If you have some coins, you can put them in the pool and you can earn some exchange fees, which is really great. Most liquidity pools will use an automated market maker system or an AMM. Back in the day in the stock market makers were actual people who did all that thing with their hands and bought and sold and actually facilitated trade between a buyer and a seller to big organizations. Now that is done on the blockchain by a computer system. The AMM will match a buyer and seller and will get a decent price for them both with the swap. What are the pros and cons of this? Well, DEXs are really decentralized, so no one owns them. Also, they're very low cost. You have massive access to really small altcoins, which you may want to go ahead and trade. They also offer staking and rewards. So like I said, put your coins in a liquidity pool and you'll earn trading fees. That is a way to increase the income that you get from your cryptos. There are also staking rewards as well to increase liquidity, so you get paid for that. You earn commission instead of paying it. Obviously, you pay it when you trade. There are security concerns for DEXs though. A lot of security concerns, especially smaller DEXs. There have been a lot of rug pulls, millions of dollars stolen, so that's definitely a downside of a DEX. You might just want to stick to the top 1 or 2 DEXs, and they are way too slow for day trading. We cannot use a DEX for day trading. We get no charts, we get no order book, we get no technical analysis, and they require a cryptocurrency wallet to go ahead and use them. Here is the pros and cons of a DEX versus a centralized exchange. You can read these, but essentially a DEX is very, very low cost. You get access to small coins. You get yield farming, so you can actually earn more. You can earn commission by putting your coins in, but it is very blockchain and very crypto. A centralized exchange is just like trading on the stock market or anything else. You have an actual company who is there providing you a product. You get ultra fast trading. You get all the pro trading tools. You get great charts. You get a lot of liquidity, which is super important when you're trading a lot of money. There are some downsides, but centralized exchanges are an absolute must if you are a trader. So What's the recap? DEXs offer swaps and yield farming. That's a positive. They only run on smart contract blockchains. They have pros and cons in terms of they're slow and they're also not great for day trading. And they also have security concerns if you go for the less well-known DEXs. We're going to have to use a centralized exchange to day trade and swing trade our cryptocurrencies. Unit 5, and we're getting into the good stuff. If you haven't done already, check the description for everything I'm mentioning in this video. Do like the video and subscribe if you haven't done already. Crypto trading strategies, this is what you want to know. So what are trading strategies? What are the best trading strategies? What type of investor are you? Are you short, medium, or long term, or are you a mix of these? And what is dollar cost averaging? Super important to know. Now this links with Unit 8. Everything I'm going to talk about from now on is really a build up to the end of the video where we're going to be trading. We're going to be going through trades, but you have to know everything first to build up to what we're actually going to do. You need to know the basics, so we're going to get into it right now. First, I'm going to come on to swing trading. Super popular. A lot of people do this with stocks, Forex, and cryptocurrencies. Swing trading is short and medium term only. This isn't a long-term strategy. You open trades for maybe a couple of days, maybe a couple of weeks, but with swing trading, you're looking maybe a few days, maybe a couple of weeks, depending on the trade. You use both technical and fundamental analysis for your trading, but we certainly rely on technical analysis for when we're getting in and out of our trades. And what you want to do with swing trading is just capture a percentage of a price move. So you want to anticipate a move in the price, either up or down, and then place your trade so that you get at least a percentage of that and make your money. One of the benefits of swing trading is that it requires less time. You don't need to be researching. You can use some technical analysis here to just get right in and start trading. You can definitely make some short-term profits. And with swing trading, what I would be using is the one-day chart. If that doesn't make sense, it will do later on in the video. We're going to be using a one-day chart for swing trading. Downsides of swing trading, could miss out on the longer term trends. You know, if you just invested in Bitcoin 5 years ago, you'd be up a lot now and you wouldn't have had to have done anything with swing trading. So that's definitely a downside of swing trading. And with swing trading, you can be stopped out a lot with short-term movement. So you actually may be right about a trade, but in the short term, the price could just move up in the wrong direction, stop you out of a trade. So you make a loss, but you were right about the trade. So that's just part of trading, one of the downsides of swing trading. Thanks to Investopedia for this image though. I'm going to use this to describe what swing trading is. Now we can see, we can use a chart, we can use some analysis and some chart patterns to go ahead and swing trade. If you think this looks crazy, I'm going to explain exactly how to do it later on in the video. We can see a small cup and handle pattern right here. And we also have a consolidation period right here. These things are what swing traders use to trade. You can get into a trade around here. You can ride that. That is a swing. And then you can put some stop losses in place and basically get out. So a swing in the market, you've taken a percentage of that move and then got out of your trade and made your money. I'm going to be showing you swing trading and also breakout trading later on in the video. What is breakout trading? Breakout trading is slightly shorter term than swing trading, but it can be for the same amount of time. It really depends on you as a trader. You open trades for maybe even a few hours to a couple of days, and you mainly use technical analysis, but you need also to know what's going on in the markets and what types of news may move the markets as well. We can use specific chart setups for this, and I'm going to show you exactly how I trade and how you would go ahead and do a breakout trade later on in the video. We want to capture a breakout in the price. Now, what is a breakout? Well, there are specific things we look for that show us whether there is going to be a breakout or not, and that's how you trade. It requires way less time because you're really just looking at potential breakouts and you're putting your trades in. Definitely short-term profits with this one. We can use either the one-day chart or maybe the 8-hour or 4-hour chart, depending on who you are as a trader. You could miss out on longer-term profits once more. And again, short-term swings can stop you out of your trades, making a losing trade, but it may actually go in that direction. That happens quite a lot with breakout trading, so something to be aware of. Thanks again to Investopedia for this one, but this is essentially a breakout. So what happens is trade in an asset, let's call it Bitcoin, will actually go and consolidate like this. And we use these lines, and I'll talk about that later. This is actually what we call a wedge pattern, and it is possibly going to have a breakout from that pattern eventually. So this is what breakout trading is, trying to spot areas of consolidation that could then lead into a breakout. Place your trade, get that move and the volatility in the price, and maybe take advantage of it. We can see right here, this is the area of consolidation that we want to look for. Breakout traders will look for this to place their trades and essentially try and make some money when the price breaks out of that bracket. Another strategy is called scalping. Ultra short term, I'm talking intraday trades. You'll maybe looking at a 5-minute chart, trading 10, 20, 30 times a day even. There are computer systems that scalp as well. You may open trades for a few minutes to a few hours, certainly not overnight and not a few days. Only rely on technical analysis and nothing else. You trade off tiny movements in the price. Now this requires a lot of time, a lot of effort. You have to be watching the screen at all times. But you get hundreds of trading opportunities per day, definitely. So if you want to trade a lot, look at scalping. There are a lot of opportunities to trade with scalping that long-term investing just doesn't give you. Essentially what you're doing with scalping is actually trying to trade off other people's orders. If a huge buyer comes into the market over a very short period of time, the price may move up a tiny amount, let's say 0.25%. In Forex, it's going to be much smaller, but in cryptocurrencies, it might be 0.25%, maybe 0.1%. As a scalper, you're trying to anticipate that, get in off the back of their order and try and basically buy some crypto before they finish their buy and then sell it to them as well. It definitely requires more funds. It's very difficult and time consuming to implement, but this is what a scalping setup would look like. I have a 5-day, an 8-day, and a 13-day moving average on here, and you can see all of these swings. So we have one swing right here. Now remember, this is intraday. This is a 15-minute chart. So every candlestick right here is 15 minutes. If you don't know what candlesticks are, if you don't know what this chart is, don't worry. All of this is going to be explained as we go through the video. You can see though, this is an area where we could trade. We could try and ride this up and then sell up here. We can also ride this movement as well. Now these lines here are a very simple way to try and anticipate movements in the price. We also have a movement of the price here, and we also have a movement of the price here. These are ultra short-term intraday price movements that a trader can take advantage of, and you can just make your profits like this. Now, one of the downsides is that it can move against you